96 years, 7 major collapses, $73 trillion in wealth vanished, gone, evaporated from bank accounts, retirement funds, and family savings across the entire planet. Every single financial crisis in modern history follows the exact same pattern, the same psychological stages, the same warning signs ignored, the same experts dismissed, the same catastrophic outcome. And yet, every single time without fail, the people in charge say the same 4 words. This time is different. It's never different. The players change. The financial instruments change. The technology changes. The jargon gets more sophisticated. But the psychology, the fundamental pattern, identical every single time. What you're about to hear is the complete timeline of every major financial crisis since the Great Depression. Not just what happened, but why it keeps happening. Why we never learn. Why the same mistakes get repeated by different generations wearing different suits. Because right now, in 2025, those same warning signs are flashing red again. The same signals we ignored before every previous collapse. And most people, they're not paying attention. Again, let's start where it always starts, with confidence. With the belief that we've figured it out, that we've conquered the old problems, that the rules have changed. August 1929, the United States stock market had climbed steadily for 8 consecutive years. The Dow Jones Industrial Average had risen 400% since 1921. Not 40%, 400%. Everyone, and I mean everyone, from shoeshine boys giving stock tips to investment bankers to college. Professors believed they'd discovered a permanent formula for wealth creation. Margin buying had become standard practice. You could walk into a brokerage, put down just 10% of a stock's price, and borrow the rest. Why wouldn't you? Stocks only went up. If you bought $10,000 worth of stock, you only needed $1,000 in cash. When those stocks rose to $12,000, you'd made $2,000 on your $1,000 investment. A 200% return. It was free money. Except, of course, when it wasn't. This is the first pattern you need to burn into your memory. Complacency breeds excess. When markets rise low enough, risk stops feeling like risk. It transforms into opportunity. Fear becomes greed. Caution becomes cowardice. The Federal Reserve, created just 16 years earlier in 1913, kept interest rates low throughout the decade. Credit was cheap and abundant. Everyone believed America had genuinely entered a new era, a permanent plateau of prosperity, where the old economic laws had been fundamentally rewritten. But beneath all that celebration, the foundation was cracking. Agricultural prices had been falling steadily for years. European economies, still recovering from the devastation of World War I, were drowning in unpayable war debts. American consumers were maxed out on installment purchases. Corporate earnings had started to plateau by early 1929, but stock prices? They kept climbing. The disconnect between actual business performance and stock valuations grew wider every month. The warning signs were absolutely there. Roger Babson, a respected financial statistician, gave a speech on September 5, 1929, where he predicted a crash was imminent. The market dropped 3% that day. Financial newspapers mocked him. But then the market recovered over the next few weeks, because it always recovered. Markets always went back up, until suddenly they didn't. This is the second pattern. The people who see disaster coming are always dismissed as pessimists, doomsayers, and permabears, right up until the moment they're proven catastrophically right. October 24th, 1929. Thursday. Black Thursday. The market opened and immediately began hemorrhaging value. Within the first hour, panic had set in. 12 million shares traded hands by the closing bell 3 times the normal daily volume. The ticker tape machines, the technology that transmitted stock prices across the country, couldn't keep up. They fell hours behind. By noon, No one actually knew what anything was worth anymore. A group of major bankers, led by J.P. Morgan Jr., pooled their money and started buying stocks publicly to stabilize the market. It worked, temporarily. Confidence returned. Friday was calm. Saturday markets were closed. People thought maybe the worst was over. They were wrong. Then came Tuesday, October 29th, Black Tuesday. The true collapse. 16 million shares sold. Everyone selling. Nobody buying. The Dow dropped 12% in a single day. But here's what most people don't understand. That wasn't the bottom. Not even close. That was just the beginning. The market didn't crash and recover. It crashed and kept crashing, relentlessly, for nearly 3 years. By July 1932, the Dow Jones had lost 89% of its peak value. 89%. If you had $10,000 invested in stocks in September 1929, you had $1,100 left by July 1932. $9,000 gone. 9,000 American banks failed between 1929 and 1933. When a bank failed, you lost everything. No FedEc insurance. Your life savings simply vanished. 1 in 4 Americans lost their jobs. Unemployment hit 25%. The Great Depression had begun. Fast forward through World War II. America emerged as the undisputed global superpower. The economy boomed for 2.5 decades. The GI Bill created the middle class. Interstate highways connected the nation. The Bretton Woods system established the dollar as the global reserve currency, backed by gold. This created what seemed like permanent stability. The stock market rose steadily. GDP grew consistently. Recessions were mild and brief. Economists genuinely believed they'd figured out how to manage the economy through fiscal and monetary policy. The business cycle was dead. Prosperity was permanent. But by the late 1960s and early 1970s, cracks appeared. President Lyndon Johnson funded both the Vietnam War and Great Society programs without raising taxes. The Fed printed money to finance both. Inflation started creeping up. Then came the oil shocks. In October 1973, OPEC imposed an oil embargo. Oil prices quadrupled virtually overnight. Suddenly, America faced something economists thought was theoretically impossible: stagflation. Rising prices combined with zero economic growth. High inflation and high unemployment occurring simultaneously. The 1970s became a lost decade. Stocks went nowhere for 10 years. Inflation hit 13% by 1980. Unemployment reached 10.8% by 1982. People waited in mile-long lines just to buy gasoline. Interest rates hit 20%. 20%. Imagine trying to buy a house with a 20% mortgage rate. Paul Volcker, appointed Federal Reserve Chairman in 1979, made a brutal decision. He would break inflation, even if it meant breaking the economy. He raised interest rates to levels never seen before or since. It worked. Inflation died. But so did thousands of businesses and millions of jobs. October 19, 1987, Black Monday. The Dow Jones dropped 22.6% in a single day, the largest single-day percentage decline in market history. Not just American history, world history. Bigger than 2008, bigger than 2020, bigger than anything before or since. What happened? A new financial innovation: portfolio insurance. Computer programs designed to automatically sell stocks when prices fell below certain predetermined levels. The idea was sophisticated risk management. Protect your downside with automated hedging strategies. But when one computer program started selling, it pushed prices down, which triggered another computer program to start selling, which pushed prices further down, which triggered more programs to sell. A feedback loop. Human panic and fear, automated and executed at machine speed. By the closing bell, $500 billion in wealth had evaporated in 6.5 hours. Here's the third pattern. Every crisis gets amplified by whatever new financial technology seemed sophisticated at the time. In 1929, it was margin buying with leverage. In 1987, it was computer trading and portfolio insurance. Watch this pattern repeat again and again. The crash of 1987 was contained relatively quickly. The Federal Reserve flooded the system with liquidity. Markets recovered within 2 years. No recession followed. This taught everyone a dangerous lesson. Crashes can be managed. Central banks can rescue markets. Just add liquidity and everything fixes itself. July 2nd, 1997. The Thai baht collapsed overnight. Thailand had borrowed heavily in US dollars to fuel rapid economic growth. They maintained a fixed exchange rate. But when currency speculators attacked, Thailand couldn't defend a peg. The currency lost half its value within weeks. This crisis didn't stay in Thailand. It spread to Indonesia within days, then Malaysia, then the Philippines, then South Korea. Currency after currency collapsed. Stock markets crashed across Asia. By late 1997, the contagion reached Russia. The ruble collapsed. The Russian government defaulted on its debt. Long-term capital management, LTCM, a hedge fund run by Nobel Prize-winning economists, the smartest guys in the room. They'd borrowed $125 billion against just $4 billion in capital, 30-to-1 leverage. For every dollar they actually owned, they'd borrowed 30. When Russia defaulted, their sophisticated mathematical models broke. LTCM faced total collapse. And because they owed money to every major bank on Wall Street, their collapse would trigger a chain reaction. The Federal Reserve orchestrated a private sector bailout to prevent total systemic meltdown. Notice the pattern yet? Excessive borrowing. Sophisticated models that fail during stress. Contagion spreading faster than anyone predicts. And bailouts preventing collapse. Every single time. March 10th, 2000. The Nasdaq Composite Index peaked at 5,048. We'd entered what people genuinely believed was a new economy. The internet changed everything. Old rules about revenue and profits, obsolete. Old economy thinking. Companies with no revenue, no profits, no viable path to profitability had billion-dollar market valuations. The metric became eyeballs. How many people visited your website? If you had traffic, you could get funding. Pets.com sold dog food online at a loss on every sale, but commanded a massive valuation. This time is different, they said. The internet changes everything, and it did change everything, just not the laws of basic economics. You still needed revenue. You still needed profits. You still needed a sustainable business model. By October 2002, the Nasdaq had fallen 78% from its peak. $5 trillion in market value had evaporated into thin air. Thousands of companies simply vanished. The supposedly sophisticated venture capitalists who'd funded this insanity faced the same reality every generation eventually faces. You cannot value companies based purely on hope and hype. This is the fourth pattern. Every generation believes they've discovered a new paradigm that exempts them from economic gravity. Every generation is wrong. Now we arrive at the big one. The crisis that nearly destroyed the entire global financial system. The one that proved the entire edifice was built on sand. It started so simply. Housing prices never go down. That was the foundational belief. Sure, individual houses might lose value. Maybe certain neighborhoods or cities. But nationwide housing prices had never fallen in modern American history. Never. So lending money for houses was basically risk-free. Banks began lending to anyone with a pulse. No income verification? No problem. They called them ninja loans. No income, no job, no assets. Just sign here. Adjustable rate mortgages with teaser rates pay almost nothing for 2 years. Then your payment triples. But don't worry, you can refinance before then, because prices only go up. But here's where it morphs into something truly systemic. Banks didn't keep these mortgages on their books. They bundled thousands of them together into mortgage-backed securities, sliced them into different risk tranches, paid rating agencies to stamp them AA safe, and sold them to pension funds, insurance companies, and foreign governments around the world. Credit default swaps, essentially insurance policies betting on whether these mortgage bonds would default, exploded from $900 billion in 2001 to $58 trillion by 2007. $58 trillion. That's more than the entire global GDP at the time. And nobody, not the banks, not the regulators, not the rating agencies, actually understood where all the risk was hiding. Housing prices peaked in mid-2006. Foreclosures started rising. Bear Stearns' two major hedge funds collapsed in July 2007 after massive losses on subprime mortgages. But the mainstream narrative remained consistent. The problems are contained to subprime. It's a small sector. The broader economy is fine. This is the fifth pattern, and maybe the most important. Denial continues at maximum intensity until the very moment collapse becomes undeniable. September 15, 2008, 1:45 a.m. Eastern Time. Lehman Brothers declared bankruptcy. Not a government bailout, not a Federal Reserve rescue. Bankruptcy. A 158-year-old institution with $639 billion in assets simply ceased to exist. What happened next can only be described as financial apocalypse. Within hours, money market funds, supposedly the safest possible investment outside of cash, broke the buck. People who thought they had absolutely safe money woke up to losses. The commercial paper market froze completely. Companies with perfect credit ratings couldn't borrow money at any price. September 16th, American International Group, AIG, received an $85 billion emergency government loan, the largest bailout in American history. At the time, September 25th, Washington Mutual, with $307 billion in assets, failed, the largest bank failure in American history. September 29th, the House of Representatives rejected the first version of the bailout bill. The Dow Jones dropped 777 points in a single day. October 2008 became the worst month for stocks since October 1987. The S&P 500 fell 16.9% in 30 days. Investment bank after investment bank collapsed or got emergency acquisitions. Bear Stearns, gone. Lehman Brothers, gone. Merrill Lynch, sold to Bank of America in a weekend. 8 million Americans lost their jobs between 2008 and 2010. 6 million. Americans lost their homes to foreclosure. Families who'd lived in the same house for decades found themselves evicted. Retirement accounts were slashed in half. People in their 60s planning to retire watched their 401 kiloseconds collapse. Decades of careful saving gone in 18 months. The median American household lost 39% of its net worth between 2007 and 2010. Wealth that took entire lifetimes to build vanished in less than 2 years. Global trade collapsed. Iceland's entire banking system failed. Ireland's economy imploded. Spain, Italy, Greece, Portugal faced sovereign debt crises. The crisis that started with American subprime mortgages had metastasized into a global financial pandemic. By March 2009, the S&P 500 had fallen 57% from its 2007 peak. $17 trillion in American household wealth had vanished. Fast forward 11 years, the markets had recovered. The economy had recovered. Unemployment dropped to 3.5%, the lowest in 50 years. Stock markets hit all-time highs week after week. The 2008 crisis seemed like ancient history. Then came a virus. March 2020, COVID-19 shut down the global economy virtually overnight. The S&P 500 fell 34% in just 23 trading days. The fastest crash from peak to bear market in recorded history. Faster than 1929. Faster than 1987. Faster than 2008. But the policy response was unprecedented. The Federal Reserve didn't just lower interest rates to zero. They bought corporate bonds, junk bonds, mortgage-backed securities, municipal bonds, even exchange-traded funds. The Fed's balance sheet exploded from $4 trillion to $9 trillion in a matter of weeks. The government sent checks directly to citizens. $1,200 per person, then $600, then $1,400. 3 rounds of direct stimulus payments. In total, the U.S. government injected over $5 trillion in stimulus in 2020 alone. And the market? It bottomed on March 23, 2020, and then rocketed straight upward. By August 2020, just 5 months later, the stock market had not only recovered, but hit new all-time highs, while unemployment was still above 10%, while businesses remained closed, while the pandemic raged completely uncontrolled. Central banks and governments had discovered they could simply print unlimited money and buy unlimited assets. The old rules about inflation, about deficits, about debt, apparently they didn't apply anymore. Or so it seemed. Let's zoom all the way out. 96 years, 7 catastrophic crises. What have we actually learned? After 1929, Congress passed sweeping reforms. The Glass-Steagall Act separated commercial banking from investment banking. These reforms worked. For 66 years, America didn't experience a major banking crisis. And in 1999, Glass-Steagall was repealed. It took exactly 9 years for disaster to strike. 2008. After 2020, by 2021, inflation started rising. By 2022, it hit 9%, the highest since 1981. All that printed money had to go somewhere. The Federal Reserve suddenly had to raise rates faster than any time in 4 decades. Here's the uncomfortable truth. We've been trained to expect rescues. Every crisis since 1987 has involved massive government intervention, bailouts, stimulus, quantitative easing. And each rescue is bigger than the last. Each creates more moral hazard, the belief that someone will always catch you when you fall. Every crisis follows this exact 6-stage pattern. Stage 1. Complacency. Long periods of stability create the belief that risk has been permanently eliminated. We've figured it out this time. Stage 2. Excess. Cheap credit fuels speculation. Leverage multiplies. Asset prices detach from underlying fundamentals. Stage 3. Warning signs. Small cracks appear. Experts begin warning, but the mainstream narrative dismisses these concerns. It's contained. Stage 4. Acceleration. The problems spread faster than anyone predicted. Contagion operates at exponential speed. Stage 5. Panic. Reality hits all at once. Everyone tries to exit simultaneously. Liquidity vanishes. Stage 6. Collapse. The system seizes. Confidence evaporates completely. Government intervenes with emergency measures. This pattern has repeated 7 times in 96 years. The specific triggers were completely different: stock speculation, oil shocks, computer trading, currency pegs, internet stocks, housing bubbles, global pandemics. But the underlying psychological and economic pattern, identical every single time. Here's what financial media never emphasizes. Each crisis transfers enormous wealth upward. After every collapse, assets become cheap. But who has capital to buy during a crisis? Not people who just lost their jobs. Those with capital, the wealthy, institutions, private equity funds, they buy assets at fire sale prices. When markets eventually recover, those buyers capture all the gains. After 2008, the top 10% of Americans recovered their wealth fully within 5 years. The bottom 50%? Many still haven't fully recovered. After 2020, billionaire wealth increased 54% in 1 year, while 100 million people globally fell into extreme poverty. So where are we right now? Late 2024, early 2025. Let's check the pattern systematically. Stage 1, complacency? Absolutely check. The S&P 500 hit 62 all-time highs in 2024. Every single dip gets bought within days. Stocks only go up has transformed from satire into genuine belief. Nobody fears anything. Stage 2, excess? Definitely check. Corporate debt stands at $10.5 trillion, an all-time record. Private equity firms have $2.8 trillion in cash, searching desperately for deals at any valuation. The Magnificent Seven technology stocks account for virtually all market gains. Remove those 7 companies and the market is basically flat. Stage 3, warning signs? Multiple signals are flashing. Warning sign 1, the yield curve. The curve inverted sharply in 2022 and 2023. This has predicted every recession since 1969. Every single one. 0 false signals in 55 years. Warning sign 2, commercial real estate. Office buildings across America sit 30 to 50% empty. Meanwhile, $1.5 trillion in commercial real estate loans mature in 2024 and 2025. Banks holding these loans face massive potential losses. Warning sign 3, private credit. Since 2008, enormous amounts of lending moved from regulated banks to unregulated private credit funds. Total private credit outstanding exceeds $1.5 trillion. Nobody knows the total exposure. Nobody knows who holds the risk if borrowers default. It's the same pattern as 2008 mortgage-backed securities. Warning sign 4, artificial intelligence speculation. Companies adding AI to their name see stock prices double. The parallels to .com year 2000 are striking. Does AI matter? Absolutely. Does that justify current valuations? History suggests skepticism. Warning sign 5, government debt. U.S. federal debt now exceeds $35 trillion. Annual interest payments alone cost over $1 trillion more than defense spending. When rates were 0, this was sustainable. At 5%, the math becomes uncomfortable. Warning sign 6, geopolitical instability. Wars in Ukraine and the Middle East. U.S.-China tensions escalating. The post-World War II global order is fracturing. When geopolitical stability cracks, financial stability usually follows. Are these signs definitive? No. Every warning sign can be rationalized away. It's contained. It's priced in. The Fed will handle it. It's different this time. We've heard these exact phrases before. Every single previous crisis. But here's what history teaches. Every crisis had warning signs. Every crisis had experts sounding clear alarms. Every crisis had a majority dismissing those alarms as pessimism or fear-mongering. Until suddenly, everyone couldn't ignore reality anymore. The question isn't whether another crisis will happen. History absolutely guarantees it will. Financial crises are features of the system, not bugs. They're inevitable consequences of human psychology meeting complex leverage. 96 years of history, 7 catastrophic collapses, 1 unchanging pattern. Financial crises aren't unpredictable acts of God that strike without warning. They're the inevitable result of human psychology meeting complex financial systems. We forget the lessons of the past. We rationalize away warning signs. We convince ourselves that the rules don't apply this time. And then reality reminds us they always do. The timeline you just heard isn't a history lesson you'll forget by tomorrow. It's a field guide, a pattern recognition manual. Because somewhere right now, at this very moment, the seeds of the next major crisis are being planted. The excessive leverage is building. The warning signs are appearing. The experts are being dismissed. The cycle is beginning again. The question isn't, will this happen again? History answers that definitively. Yes, absolutely yes. The question is, are you prepared when it does? Do you recognize the pattern? Can you see stage 3 warning signs before stage 5 panic hits? Understanding the pattern is power. Knowledge is the ultimate edge. The people who study history don't just avoid repeating it, they profit from everyone else repeating it. What warning signs do you think we're missing in 2025? What patterns are developing right now that everyone's dismissing? The next crisis is coming. It always does. Understanding the pattern is the first step. Using that knowledge, that's where real power comes from. Don't be the person who ignores the warning signs. Be the person who sees them coming.